I'd like to welcome back personal finance expert and financial commentator Pattie Lovett-Reid to our show. Pattie is known for providing tips on how people can save money and stretch their incomes. Many of you will recognize Pattie from her days as a former senior financial commentator for CTV News. She also served as a senior vice president at TD Waterhouse, Canada. Welcome back to our show, Pattie. Thanks for
Thank
being
you.
here.
Thanks for having me.
Excellent. I also like to welcome back Jonathan Chevreau to our show. John is an author, the CFO, and founder of the Financial Independence Hub, North America's gateway to financial independence, the investing editor at large with MoneySense magazine. And many of you may recognize John from the personal finance column that he wrote at the Financial Post newspaper for 19 years. Welcome back to our show, John. Thank you for being here as well.
Thanks for having me back here, Alan.
Hey, it's great to have the two of you back. As I said, the last time, I think it's been about a year that we had both of you on. Times have definitely changed
Mm.
since then. A lot has happened, perhaps for the good and maybe not so good. Investors are definitely a little bit more, should I say, concerned about what they're seeing in the world today. And there's a lot going on. So, wanted to, as I always do, start off with more of a general question for the both of you to answer. And I thought about asking, with respect to the uncertainty in the world today, inflation fears, tariff worries, possible slowing of economy, possible job loss due to tariffs, et cetera, on both sides of the border, Canada and the US. What would your general comments be to investors right now? Would you be telling them, not to worry, that this is a buying opportunity? Would you be saying, no, you may want to think about selling, getting out of this market? Perhaps you would say nothing at all, just hold tight. What advice would you give investors and why? And I guess we'll always start ladies first. So, Pattie, what would you be saying to investors today?
Well, here's the thing, Alan. I, fortunately or unfortunately, have been around in this business for a long, long time. I could go back to 1995 when we had the Chinese financial crisis back then. I could then say, all right, then move forward. We had dot-com bubble, we had 9/11, we had 2008, the global financial crisis. I think there was the China's currency crisis that was in 2015. Then we had COVID. And now we have what I call the triple T, and that would be Trump trade and basically, well, call it whatever you want to call it, but it's all tension. So, every single time we go through this market turmoil, I have the same feeling, ooh, it's different this time. And it is different this time in that we have an individual sort of wreaking havoc on a global platform. But I've said that every time. And so I always believe in long-term quality investments, stay the course. You may get a little more defensive in your portfolio with utilities and telecoms, financials. Gold has definitely been a benefactor, and you stay the course. But if you're not sleeping at night, then talk to your advisor. There may be some tweaking required. I can tell you in the interest of disclosure, we've done nothing. We're staying the course with our portfolio.
So I guess you would be saying stay the course. So you're on the do nothing, just wait it out and see how it goes. John, what about yourself? What would you be saying to investors today? What are individuals that you come across every day and at your job and what you're doing? What are they telling their investors right now? Are they saying to just do nothing and stay the course, or are they perhaps using this as a buying opportunity?
Hmm. Well, going back to Patty's three T's, I thought she was going to say terrified.
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 Trump trade tension, but
Yes.
whatever.
On my Financial
Tariffs.
Independence Hub a couple of weeks back, another advisor, John DeGoey, I'm sure you guys know him,
Mhm.
uh, had a blog which was titled "The Gangster in the White House," and he was a little bit less politically correct than a lot of people in his position
Ooh,
are
yeah.
about that, and he was sort of like departing from the usual that I mean I would agree with Patty normally. It's like stay the course. It always makes sense. It never makes sense to panic. Nobody ever made money panicking. But to go is arguing like with this madman in the White House. I saw the National Post had an article today on this really gloomy um, study about Canada being in dire straits, and there was a reference that they flagged right on the front page about madman in the White House. So Degoe's argument is sort of that all bets are off. Like this time is different. Maybe this time it is different. So he was just certainly advocating for retirees at least, dialing down risk, as he put it. Now, I mean, Patty mentioned there are many things you can do. There are consumer staples and defensive stocks and
Mhm.
utilities and healthcare stocks. Those are still stocks, though. From an asset allocation, I mean, I just turned 72 and now I have a riff. So I've all these years of talking about RSPs, and all of a sudden I gotta like sell stuff every year, every month. And luckily, again, going back to Patty, I had some gold I could sell because I bought it way a long time ago, and it's tough to sell losing positions. So my own personal financial advisor, he's more or less again for riff ages, rather than the classic balanced fund allocation of 60-40 stocks bonds. He's flipped it to 60% fixed income. If you're a cautious conservative investor and you don't have a traditional employer pension plan, even 80% fixed income. Young people, yeah, of course it's a buying opportunity. If you're under 30, and you should be thanking your stars that King Trump has given you this buying opportunity.
King Trump, I like that. I like that. So
Mhm.
I guess that you're saying depending on age and depending where you are, investment objectives, then you could be a person holding or perhaps using this as a buying opportunity. I like that. And I guess your comments about riffs and yourself leads me actually to my first or my next question, I should say. And we'll ask you, John, since you brought it up. I wanted to really focus on investor psyche at this point in time, investor emotions, because I talk a lot, as you both know, to investors everywhere, business owners, to sole proprietors, to just the average investor with their RSPs or RIFs, and people are nervous out there, and they have a lot of questions. But a couple of questions that have come up quite often, I thought I would throw to my panel today, to the two of you. And the first one is stemming from your comments, John, about RIFs, is that I get the question most often, I am approaching retirement or I just entered into retirement. I don't have a lot of time to make up for any big losses that are happening now or that may happen down the road. And so people are asking me, what should I do? They have those comments. So what would you say to someone who says, I don't have a lot of time to make up any potential for big losses. Now how should I structure my portfolio?
Well, I mean, just to flog my blog again, today, actually, BMO's a sponsor and they get a monthly blog. And today is actually on Asked Allocation ETFs. And of course, iShares has them and Vanguard. Everybody has these things. It can be very simple. I mean, it just like it makes sense to use a professional advisor like yourself, Alan, or Degoe or anybody else, or Patricia when she was in that end of the thing. It also makes sense when you have ETFs certainly seem to be the accepted investment vehicle these days. An asset allocation ETF, basically you're punting it over to the professionals. Let Vanguard or let iShares decide what your asset allocation should be, having done your investment questionnaire and decided your risk tolerance and your stage of life, whether it's 60-40, 80-20, whatever it is. Once you've decided and it's considered how you're freaking out about the madman in the White House, tariffs is going to wreck everything, the prices of everything, inflation's taken off, gold's taken off. Let them decide. Yes, stay the course, but stay the course with the professional vehicles that have already taken into consideration where you are in your personal journey,
Mhm.
your age, and what other sources of income you may have.
Yeah, and great points for sure. Patty, what would you say? I'm sure you've had this come up in your
Yeah,
career when you
yeah.
were managing money at TD, perhaps, and someone says, you know what, I'm turning 70 next year. I don't have a lot of time before I have to change my account over to a RIF. I'm nervous, if I have these big losses, I won't have enough time to make back some of these losses before I actually start pulling money out. How would you advise them at that point?
Well, I just want to go back to, and I have been talking to retirees, near retirees. We could spend a third of our life in retirement. That's a long time. We've been talking about being terrified with the tariffs. the trade tension, and, everyone's talking about inflation. And so I think it's about maintaining your purchasing power with a balance. And I do think stocks for the long run. Now, that doesn't mean you become overexposed. There is a big difference, and I understand what Jonathan's saying, because, my whole life and our whole life here is, been asset accumulation. To some extent, it's asset preservation now. And so we have taken some risk off the table, but we didn't do it in the midst of a crisis. We've done it through lifestyle, life stage. And I think for people who are in retirement, you need to be razor sharp on where is your money coming from in retirement. To Jonathan's point again, do you have a pension plan? Do you have a RIF? Do you have government benefits? What makes sense and in what order? And depending on when you retire, if you have a 5-year time horizon, and, many do, Jonathan, you do, I do, I'm just going to throw it out there. We have time to allow the markets to come back. And so the last thing I want is for someone to have this feeling of capitulation, throw in the towel, move to the sideline, panic. And then you're absolutely right. You are locking in potentially a loss that you may not have time to get back. So I still maintain in the midst of a crisis, it's not always the best time to rebalance, but it's always a good time to look at that asset allocation and making sure that if you don't have the strength and the fortitude to allow to sort of check some of the emotions at the side, work with an advisor, work with a planner. We have a planner. I have the credentials. I could manage money again, but we have someone managing our portfolio. We're checking in regularly, and we're looking, where's the strength? Where do we have some weakness? Where do we need to come back?
Yeah, no, all great, great advice for sure. My next question, I'll ask Patty first because I'm sure you've heard this one many times, and I've been getting it a lot lately. And it's the question of, Alan, why can't we just exit the market and go back in when the coast is clear? I
Yeah,
get that a lot.
me
And
too.
people, when they ask me this question, I think they know what I'm going to say, and they don't even realize, I say, well, you can't really time markets, but am I timing markets, Alan? I just want to get out. And then, when things look better, maybe when some deals are made down the road, maybe the market will look better and I can get back in. What would you say to an investor that asks you that question? Should I get out, exit,
Yeah.
and get back in later when everything looks better?
Here's what I know for sure. No one in the market or the markets themselves are going to wave a white flag and say, hey, by the way, the market has bottomed. It's now time to get back in. And statistically, I don't have the numbers at my fingertips, but statistically, we know rallies happen very hard, very quickly when you least expect it. If you exit the market, you lock in that loss. And then when things turn very quickly, some of the biggest gains happen immediately after we presumably hit near or at that bottom. And so therefore you have locked it in. But I still go back. I mean, if you're that nervous, you're not sleeping, maybe your exposure into the stock market was never right to begin with. And so that's a different conversation rather than trying to time the market, because you got to get it right twice, going out and more importantly, getting back in. And I would argue there are a lot of experts out there that don't necessarily get it right 2 times.
Yeah, no, absolutely. And I would argue even that getting out is easy, getting back in is the
Mhm.
hard part of
Yeah, it
that.
is.
Second part is obviously much more difficult. Along the same lines, John, I also get this comment made, and I laugh sometimes when I hear it because it's kind of funny. And investors call me up and they say, you know what, Alan, I'm not blaming you, but I knew that this was going to happen. I should have exited the market at
Yeah.
the end of January. I knew this was going to happen when I saw the new president in the White House and et cetera, et cetera, and they're beating themselves up because they knew that they should have exited the market. What would your response to that be?
Well, how good is your crystal ball? Hindsight is 2020. That's, I can give you many cliches. Um, again, we have this madman in the White House who can move the markets. We've already seen it. Like 2,000 points in a single day just on a whim.
Mhm.
And so you could have said this person who saw what was going on and they had a crystal ball that was better than yours or Patty's or all of ours together. Yes, it's definitely going down, and there are ways to play the short side and put options, etc., hedging, etc. And then had you done that, we were joking about it in our family, the day just about 2 weeks ago, that day when Trump paused the tariffs for 90 days, what did this Dow go up? Almost 2,000 points that day. If you'd been short the day before, you'd have been killed.
Yeah.
So it would have been, I mean, look, nobody has a crystal ball. I mean, yes, you should be cautious right now. Even if Kamala Harris was in power, I wish she was, I would still be cautious. I mean, right now, Warren Buffett's work Berkshire Hathaway has, I believe, US $325 billion in cash. I don't think there's been an investment vehicle in the world that has had that much cash. Yeah, he's, what's he, 95 years old or something like that. He clearly thinks things are a little overvalued, at least in the US. But even then, even though he's famously sold a lot of Apple, he also has a lot left. So again, it goes back to asset allocation. We could get into what it should be, but one of the newsletters I do follow, Grayswap, they're right now 15% in gold and precious metals, and I think they're 40% in stocks, conservative dividend-paying stocks, 15% in what they call more aggressive speculative plays, just to give you a rough idea of what their asset allocation is. They're certainly not, I mean, it's crazy to do 100% in any one asset class for any reason. That those kind of extreme moves. I mean, I was just the other day, a friend was asking this exact thing. This is what I said, like, don't make extreme asset allocation moves over transient things like who's the president.
Yeah, no, and you can tell Jonathan does these interviews all the time because he always leads me into my next question. You mentioned the crystal ball. So now we're going to ask both of you for what your crystal ball looks like. I think I did this last time you guys were on, and so I want you to dust off that crystal ball, and I want you to make predictions for the end of the year. Do you think we're lower or higher? And I guess taking it one step further, do you think everything on the tariff side works out favorably? What would you say to investors today based on your outlook of would we end up the year higher or lower from where we are today? So let's start off, Patty. What do you think? Are we
Oh,
higher today? Are we higher, sorry, at the end of the year, or are we lower at the end of the year?
oh boy. The wild cards are very serious, and it's one of those things that, the outcome of the election here in Canada, by the time this is aired, we will all know in all likelihood, or be very close to knowing. I think the relationship with the US administration's getting a lot of pressure. I think, can I say it this way? I think the S&P TSX will outperform just based on our composition. We're very attractive. It hasn't always been our time. I think it's our time to shine. We're not down all that much. Gold, metals, yeah, doing a lot of the heavy lifting. All right, so I'll go out on a limb. That's a long way to hedge my bet. Um, I'm going to say we're going to be higher than where we are today.
Excellent, excellent. I would agree with you, and you're right.
Oh.
The TSX, the gold component obviously is outshining everything, and TSX is actually flat right now for the
Mhm.
year. For this year, this calendar year. Obviously, if you go 1 year returns, it is negative, but if you go this calendar year, Jonathan, what would you say? Are we higher? Are you in the higher camp with us, or do you think we'll be lower, or do you think things will just be about the same? And what do you think about the tariffs? Are we going to get through this tariff time, or will we be talking about tariffs come October, November?
Well, I mean, this 90-day tariff pause is the $64 billion question, isn't it? I mean, I think Trump will water it down, but want to save face. So there's still going to be tariffs, but they're not going to be as extreme. We saw him basically capitulate to China in the last couple of days, and so I wouldn't want to be inside his mind and his brain, but if I did, I would say he'll probably water things down sufficiently. He says he doesn't care about in the stock market and Jerome Powell and blah 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 blah, but he does, and he figures that's how he's measured. He doesn't want to be this president who's going to be responsible for the Great Depression and the biggest stock market crash
Mhm.
of all time. Yes, he could crash it tomorrow if he wished so. And I'm sure he'd have insider trading, and all his little buddies in Congress, people would get the alert as they did last time and go short and make a killing. But I think he'll water it down. So long story short, I think probably the markets will be slightly higher. I agree with you both by the end of this year, because he's going to capitulate. But if he doesn't, look out below.
Wow. All three of us in the positive camp. This is fantastic. I love to hear that. And I would just add to that, that I think, President talks about having the cards. You've heard him reference that with President Zelensky and in Ukraine and others. You don't have the cards and the US has the cards. Well, I think ultimately the market has the cards. And I think the market will dictate whether it's the bond market, the stock market. I think the bond market even more so than the stock market. And I think that's what got the president to have that or mention that 90-day pause when he did. So yeah, I think I think the president, no different than all of us, we're at the mercy of the markets, the bond market in particular, and I think he will take his cues from there. So Pattie Lovett-Reid, Jonathan Chevreau, I want to thank you both for coming back on our show and being part of our panel today, talking about investor questions and all the different issues or ideas that investors have right now. And unfortunately, there's a lot of panic out there, as I said off the top. And hopefully today we've helped someone that's watching and listening, make sense a little bit better out of what's happening in the world today. So I want to thank you both. And I look forward to having you both on again. Hopefully we don't have to wait another year to have you both on. We can have you both on sooner. So thank you so much. And we'll talk to you soon.
Thanks a lot, Alan.
Thank you, Alan and Patty.